So payrolls growth slowed in October, but RSM's Joe Bruselas called it another rock-solid jobs report. Now, the unemployment rate had been seen as a more accurate signal this month due to the impact of the workers' strikes, that number ticking higher to 3.9%. So what does this all tell us about amid the recession versus soft landing debate? Well, joining us now is Julian Brigden, Macro Intelligence Partners Co-Founder and President. So Julian, where do we find ourselves in this discussion then?
So I think I find it very hard, I must admit, to construct a scenario where we essentially avoid a recession. I think one of the things that people don't understand is, in an environment where we have quite high sticky inflation, which is certainly what we think, but you find yourself in an unusual situation of having extraordinarily low unemployment. One of the things really you should look at is not just inflation, but look at nominal GDP. And when you do that, nominal GDP is remaining extraordinarily robust. And the reason you look at nominal GDP is because then you have to kind of parse this between inflation and real growth. So if, let's say, we get very low inflation, everyone would say, well, that's a great scenario. But the problem is if nominal GDP remains unchanged, real growth has to accelerate. That's just how the mathematics work. And it's very hard to accelerate real growth when you've got sub 4% unemployment, because the risk is that all you will do is you'll stoke wages again, and you'll end up back with those core inflationary pressures coming through. So I really think we need to continue, and the Fed needs to continue to grind this thing out. And that will inevitably weigh on momentum. And I think we are seeing some signs of that. I don't want to get too bearish at this point, but we are starting to see in this slight uptick in unemployment a beginning of a loss of momentum. Because if you go back and you look at a chart of unemployment, it's quite a strange beast. It kind of looks like a sort of scene that you would see in the mountains. So very sharp peaks, slightly rounded bottoms, and then you rise up again the other side of the valley. And that's where I think we are now. We're in risk of doing that and rising. We are not yet at a danger point. That would take an uptick if you lose the historic data to about 4.1 in unemployment. But we're definitely bleeding a little bit of momentum. But I think the Fed needs to keep hanging in there to do that, I think, unfortunately.
And something else that we're looking at with the Fed, they're allowing US Treasuries to mature and roll off their balance sheets versus buying new bonds. But when you look at the biggest buyers of US Treasuries, Japan, China, especially China, who were the biggest buyers here in terms of the momentum, pulling back then. What are the expectations here? Because you talk about the potential for a structural bond bear market. Break that down for us.
So we've believed really since 2016, and obviously you get caught a little bit by COVID, that we've essentially been in a structural bond bear market. And I think a lot of people focus particularly on the supply side, right? We've got an awful lot of debt coming out. Someone needs to buy it. That's what they focus on. What they don't look at is who is available to buy it. What's the pool of global savings available to buy that? And if you look at the pool of global savings, certainly after allowing for capital replacement, it's actually been pretty static since 2011. And as you just discussed, within that, the two big players, kind of Japan and China, their positions have been shifting. So Japan's been relatively flat. Yes, they are rolling over their treasury exposure, but China has been the big growth point, and they aren't so favorably inclined to buy US treasuries. In fact, we've been seeing them selling. So there are two sides to this equation. We're trying to sell more debt into the market as that pool of available savings is shrinking. And the demographics actually dictate that it does shrink, because in most parts of the world, there's an awful lot of people who have retirement funds and retirement pensions. And unlike the US, where they tend to be very heavily invested in equities, in most countries, they're pretty heavily invested in bonds. And when you come up to a certain age, the government dictates that you start to liquidate those portfolios. And I think that's the point that we are now, where we're seeing just this tipping, this natural demographically driven tipping point, which has been exacerbated by some geopolitics and obviously this sort of division back into the world of a Cold War, where the Chinese just aren't buying our debt to the same degree. So that's why we believe we're in a structural bear market. Doesn't mean we go straight up. Our target when we sold bonds back at the beginning of August was 5%. So we kind of got lucky when we hit that. But it does mean structurally you're in a very different world.
And obviously, we have seen bond yields pulling back so far, especially over the last week or so. But it's interesting because you note that markets are still not understanding the Fed policy here. The Fed following the Greenspan strategy of opportunistic disinflation versus what we see with Volcker. Being that the markets don't seem to be pricing this in, what's your outlook for the rest of the year as perhaps reality does sink in?
So, look, I mean, if we get some sort of dramatic slowdown, I think it's possible that we can get rate cuts. But as I said, we're losing momentum, but there's nothing very dramatic yet at this point. There still seems to be an economy that is relatively robust. And in that situation, if you're pursuing this sort of opportunistic disinflation, so basically, rather than the Volcker sort of deliberate disinflation, where you take that terminal rate and you really ramp it to an extraordinary high level so that you essentially kill the economy, the big payback on this strategy is you trade that ultimate level of terminal rates for an extended period where you hold rates restrictive. And I think the market still desperately wants to believe that we're just going to walk rates up, things will slow down, and then the Fed will immediately cut. And you don't do that in this policy framework. I mean, if we go back and we look at the Greenspan period in the late 90s where he pursued this policy and inflation was lower, and he also got extraordinarily lucky with a huge explosion in productivity. Maybe we can get the same thing through AI, but he kept rates basically unchanged for 4.5 years. And yet, if you look at what the SOFR market or the sort of short end of the US curve is pricing in, they're still pricing in pretty aggressive rate cuts. And that's not consistent with a non-recessionary outcome, which certainly the equity market isn't pricing. So we're still playing this game of equities want to rally, bonds, need to price that against them. And then when bonds rally, you get into this sort of push me, pull me game between these two markets.
We'll certainly continue to watch how that plays out here. But as you mentioned there, markets at least not really understanding the Fed policy at this point. Julian Brigden, Macro Intelligence 2 Partners Co-Founder and President, thank you so much. Have a great weekend.
Thank you.